Welcome to the Keiser Report. I'm Max Keiser. Live by the fraud, die by the fraud. Stacy, is that all the lines you're giving me today? You know, you give me some good lines to say in the beginning, and now that's it? I've been cut? This is austerity. This is teleprompter austerity. Thanks a lot.
It is teleprompter austerity, Max. But you know, it's been 5 years of near 0% interest rates here in the UK. This is 5-year anniversary this week. And I want to look at the fraud that has covered up and the fraud it has inspired. So the first headline, bank suspends worker in rigging probe. That is the Bank of England, and has suspended a member of staff after investigating potential rigging of the foreign exchange market. So that's the $5 trillion a day daily Forex market.
Right, so they're going to throw somebody onto the fire and claim that they're doing their job as regulators. However, what about the victims of the rigging crimes? Remember the savers who have had billions of pounds stolen in this country, and savers around the world that have had trillions of dollars stolen through rigging. What about them?
We're going to actually get into that, but at this moment, this is about the $5 trillion a day foreign exchange market. So this is when your pension fund has to swap pounds for dollars or euros, and in that they're front running it and rigging the WM Reuters index. So they're able to defraud the system. A lot of people here don't care, but that doesn't change the fact that they are still victims. So here, the Bank of England, in this case of the foreign exchange rigging, they're looking at reviewing whether members of its staff knew about it or condoned manipulation of currency markets. They say they don't know for sure if this guy is guilty, but one of the participants, one of the guys who has pled guilty at a private bank, one of the too big to fail banks, has said these people helped him and condoned it. So the bank itself, however, says it does not condone market rigging whatsoever. The Bank of England said in a statement, it does not condone market rigging, it says. So I want to look at this chart, and this is interest rates in the United Kingdom from 2003 to present. As you see, in 2009, it plunged to 0.5%, and it's been there since. This is market rigging, I think.
Yeah, and what about the victims around the world, the savers, you know, in the UK who have had billions of pounds stolen, and around the world that have had trillions of dollars and pounds and yen and drachma stolen due to this exact chart, which is market rigging by definition. So Mark Carney, the Bank of England, is saying complete diametrically in opposition phraseology, repudiating the very notion that he's trying to discredit by saying there is no market rigging. He is a market rigger. It is, in this economy, de rigueur, to put it in French terms. And this, of course, is a heinous crime of market manipulation that he himself is frickin' guilty of.
Yeah, and the rigging of interest rates to below where they would be if they were free markets, if there were free markets here and there wasn't a cabal of guys and some women fixing and rigging rates of what the interest rate is, what the cost of money is.
Let me point out something. You know, we had on our show a guest a couple of years ago who worked at a major credit card company who told us point blank as an insider that at the end of the quarter, this major credit card company would look at their income statement for the quarter, and depending on how they wanted to massage their quarterly income or profits or earnings for that quarter, they would either tweak the above or below the rate that they were taking on Forex. So because they're in Forex every single day, people using their credit cards to get cash in various countries every single day, the credit card company takes a rake, takes a percentage, and they simply at the end of the quarter, depending on how they want to report their earnings, and there's an incentive to report a certain predictable number to keep your stock price at a high price, they just simply adjust that rake accordingly. It's an open fraud. It's a sewer of fraud.
Well, Max, I in fact remember that conversation because I was there, and it wasn't just rigging their, you know, they wanted to make themselves look good on the markets. They were covering up another fraud. They were fined, and in order to pay that fine, they charged their thousands and millions of customers across the world a few pennies extra. Most people don't care about those kind of frauds. They don't seem to mind. So in a way, it's okay because the participants, the victims, don't really care. But in terms of the interest rates here being rigged lower, a poll finds 55% think savers being made to pay for economic crisis. A Comres ITV news poll has found that half of the British public believe savers are being made to pay for the economic crisis. The poll marks 5 years since the Bank of England dropped interest rates to their lowest level ever. It also found that a similar proportion say they are frustrated, i.e. 37% say they are frustrated with low rates, while 33% are relieved. So those are the people with big mortgages, and they are relieved. The same woman, remember that Reuters journalist who was up there with Mark Carney in Davos and said, keep interest rates low because I have a mortgage. Well, you know, those people are happy, they're relieved. The 37% who are savers are angry and frustrated.
It's not capitalism. Capitalism is based on savings. Savings are the capital. That is the basis of capitalism. You can't have capitalism without capital. You can't have capital without savings. You can't have savings without an interest rate to attract savings. So you don't have capitalism. You have casino economy. Whenever I see David Cameron, I think I see a pole dancer. You know what I'm saying? His job is to get people to spend money well above what they can afford and to speculate on the housing market. He's the guy at the casino who's paid depending on how much money the people he's escorting lose. That's the way escorts in Las Vegas are paid, not the hookers. They're just these escorts who take the whales around to show them a good time. They're paid as a percentage of how much money the people they're escorting lose. David Cameron's whole basis, or Ben Bernanke, who's now doing a roadshow, doing speeches around the world, he's being paid commensurate to how much money he caused people to lose through lost savings. So he's a casino. He's also a guy you would see at a pole dancing club, if you're into seeing overweight guys with little, pole dancing routines.
Well, so I have to try to remove that image out of my head. So here is the distortion, because, you know, when we have all this fraud and the more fraud on top of the fraud of setting interest rates below where they should be on a free market, it's creating all sorts of monsters and distortions and grotesque growths. And here's a headline from this week in the UK. Average small central London flat to cost £36 million by 2050, investor predicts. Now, it is an investor with a fund to sell, so he's trying to pitch people to buy into this fund. But he says, according to projections by one of the biggest investors in prime property in the capital, the average flat could fetch £36 million by the middle of the century if its predictions of 9% a year growth in prices become reality.
Well, again, this is economic illiteracy, because, of course, if flats are £36 million per flat, that means gas or petrol would be 50 or 60 pounds per liter. Gold would be at $10,000 or $15,000 per ounce.
At least.
Right. So he's saying he's encouraging hyperinflation. He's saying that the British pound, is set to collapse, which of course it is, against gold, silver, and Bitcoin. Which is correct. The British pound and the U.S. dollar and all fiat money is set to collapse. And you see this being played out geopolitically. The countries that have been buying tons and tons of gold, literally, are suddenly, being attacked as, oh my God, these.
But this number is great. It's absurd. It's so absurd. It's truly absurd. He's talking about one-bedroom apartments costing £36 million. Why doesn't he go out and say,
Republic.
Whoa, a loaf of bread's going to soon cost £1 million. Woohoo, we're winning.
Right.
That's the same thing he's arguing.
In hyperinflation in the 20s in Weimar Republic, it took a wheelbarrow full of cash to buy a loaf of bread. So he's advocating a return to hyperinflation.
Of course, in order to afford that sort of mortgage on a £36 million home, you need a job. Well, here in the UK, as you mentioned at the top of the show, there's a lot of austerity, and people's benefits are being cut if they don't apply for jobs, and they have to go on to find a job on the government-run website. Government's Universal Job Match website, quote, bedeviled with fraud. Around half of the vacancies on official job search website may be bogus, falsely promoted, or against the rules, says Frank Field MP. They have to go on there in order to apply for job benefits. So Field started asking questions about the website after discovering that some of his constituents had been scammed out of money by false employers who asked for bank details up front and cash for criminal record checks before disappearing with the money. Channel 4 also did their own investigation, and they found that 11,000 of the jobs don't even exist. So in terms of this fraud, perpetuating fraud, to say that everything is okay, remember they keep on saying there's a record number of job vacancies. Well, all of them are fraudulent, and in fact, some of them are going to defraud you of what little money you have left.
Well, let's explain something, because you're talking about interest rates and the Bank of England. Interest rates right now, in real terms, are negative. And the fact is that quantitative easing is not an economic policy or a monetary policy to stimulate or to encourage growth. Quantitative easing merely calibrates the rate at which the government is stealing your money. They can steal it fast with more quantitative easing, or they can taper, as they're doing in the United States, which means that they're confiscating your wealth at a slightly lower rate than they were confiscating your wealth in the last month. Again, it's the casino. The casino, when you go to the casino, they adjust the slot machines. They can have winning percentages go up, where people are then drawn into the slot machines. They'll buy fewer extra cocktails. It's a lost leader for them. Or they can adjust the winnings to be against the customer because they're trying to make a certain quarterly number at some Las Vegas casino or some casino around the world. Same thing for these credit card companies that treat their business as a casino. They adjust the winning percentages or the rake or the Forex rates, and just to accommodate their own needs as shareholders and option holders and as financial marauders. Let's use a new term today, a marauder, a financial bad actor. So that's what quantitative easing is about. It's the casino adjusting the rate at which they're confiscating your wealth. It has nothing to do with savings. It has nothing to do with capitalism. And these guys should all be ashamed of themselves because they're all welfare queens. Cameron, Osborne, and whoever runs the liberal Democrats is a welfare queen. Okay,
and finally, as we're talking about fraud on top of fraud to cover fraud, and the Bank of England being involved in fraud, and all the too big to fail banks being involved in fraud, and the manipulation of our perception of the value of currency and income, well, Goldfix study shows signs of decade of bank manipulation. So the London Goldfix, the benchmark used by miners, jewelers, and central banks to value the metal, may have been manipulated for a decade by the bank setting it, researchers say. The researcher is NYU University's Stern School of Business professor Rosa Abrams-Metz. She is famously the one that wrote the 2008 paper saying LIBOR rates were being manipulated. So she's now found that the London Goldfix is being manipulated only at the 3 p.m. fix. There's a 10:30 a.m. fix and a 3 p.m. fix. And almost always down, 95%, 96%, 97%, always down. They're rigging it down lower than it should be. And what she also found was that it only started in 2004. And if you look at a chart, a long history of a chart of gold, you'll see that that's when the real bull market started to take off.
So she's just adding facts to the what we already know are the facts. The Bundesbank told us, and other people have told us, these prices have been manipulated for years. The Gold Antitrust Action Committee have been telling this for years, so this is nothing new. In other words, to manipulate interest rates, you must, without question, also manipulate the price of gold, because otherwise, if they were manipulating interest rates and doing quantitative easing, gold would already be at $10,000 an ounce, and savers would have not gone into speculative house bubbles. They would have been in gold today. They couldn't allow that to happen. So the two are pari passu, to use a banking term. We got to go, Stacy. We got to go. Got to go. All right, stay tuned for the second half. A whole lot more.
Ukrainian fascists have come to our land. It's a threat to Russians.
Crimea is a small republic and Russia is a huge country. Defend us.
The law came to an end when the first Molotov cocktail was thrown at our guys, who stood there defending the law and order we believed in.
Crimea has never surrendered to anyone, and it never will.
Right from the scene. First-rate news and eye-gripping pictures. On our reporters' Twitter and Instagram. To be in the know, Follow us online.
Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to precious metals expert Ned Naylor-Leyland of Quilter Cheviot. Have I said all those things correctly, first of all?
It's Quilter Cheviot.
Oh, Quilter Cheviot. I didn't put that, twang on it that we have here. First of all, I got to say, your buddy Ben Davies has put 1,000 pounds into Jan Scoyle's and Stacy Herbert's Get Real show. Okay, Ben Davies, who runs Hind Capital, the gold expert like yourself.
Absolutely.
It's about gold. It's about where are you on this? How come we haven't seen you participating on StartJoin.com for this epic new series?
Well, not everyone does it directly visibly, Max. So, I
Oh,
think
that sounds like a banker. Is it derivative?
I think you can be confident that I'm very supportive of this.
Yeah, let's see some dosh,
idea.
buddy. Let's see some actual cashola. Enough
Okay.
talk. All right, let's move on. All right, now, Ned, we're talking about rigging the London gold fix today. Tell us about the evidence presented. What's happening?
Well, there have been a couple of studies lately on the subject, both of which are suggesting not only is there a problem, but that it's a downside intervention. And I think this feeds into the whole idea that the LIBOR manipulation is very similar to the precious metals one. And the reason why I would say that is because there are two layers to it. First of all, there's the clear day-to-day profiteering problem of just making money in a self-certifying market. But I think also more interestingly is the second layer, which is the structural manipulation. We had Tim Geithner talk about how he had flagged up the fact that LIBOR was managed lower. Not only was it being managed, but it was being managed lower to make the banking system look better. And the precious metals one is very similar. What concerns me slightly is that a lot of the focus about this fix investigation in gold and silver is on the ability for them to make money in an illicit way. But you and I would agree that the much more important thing is the structural intervention.
Now, usually when people think manipulation, they think, oh, we're going to make money, I'm going to manipulate it higher. Here, they're manipulating the price of gold lower. So that only makes sense in the context if you're also simultaneously manipulating interest rates via LIBOR and other mechanisms to support the bubble in things like houses and art and the items that are owned by the top 1% of the top 1%. Correct? So this is not just about crooks manipulating rates, but as you or gold prices, but as you're alluding to, on a structural level, there's a relationship between gold pricing, LIBOR rigging, gold rigging, and political machinations to keep the current folks in power. Your thoughts?
Absolutely, that's exactly the point, which is that they are managed for the same reasons by the same institutions. The difference, of course, is that with interest rates, that's an illusory market anyway, whereas with gold and silver, it's a terminal one, which is why the papers and the media are relatively happy to talk about LIBOR intervention and the fines on it and this, that, and the other. But when it comes to gold and silver, it's a more of a hot potato because there's a terminal market there. Martin Wheatley, the head of the FCA, said about 10 days ago that he was worried that beyond LIBOR, there are other London-based rates that might be being intervened in. Now, unless it's the London hobnob fix or the London sort of bacon slice fix or whatever it is he's talking about, he's clearly talking about precious metals, but he's unwilling to actually say it.
And this comes on the heels of a major investigation into HSBC and JP Morgan on silver price manipulation here in London, correct?
Not here in London. No, that's a US-based investigation which nothing ever happened with.
But London Bullion Markets Association has gone through a pretty close scrutiny through the Andrew Maguire reveals, et cetera. What's the status on that?
Well, I don't think there was any scrutiny at all, Max. I think the point is that there hasn't been any scrutiny, and that feeds into that second layer of this subject. So one is about the day-to-day profiteering to do with the fix, which is what the focus is on at the moment. But the biggest story is the other one. But the point which I think is really interesting is that it just appears to me that what's going on with the fix and the investigation into it might be something truly remarkable, which is that the European Parliament and the European legislative umbrella, for once, and entirely unintentionally, is doing something to benefit the average person and the free market. And the reason I say that is because there are principles which benchmarks have to conform to within European law, financial benchmarks. And the London fix fails on 15 of 19 IOSCO principles. And I believe that has to come in within the next year to 18 months, that it has to conform. So what I'm really saying here is that I think that actually somehow this process of investigating the fix is actually being driven by these changes at European law level, which is frankly very interesting that actually probably it's being driven from there when Basel III, the discussion about gold becoming a tier 1 asset under Basel III.
All right,
was...
let me jump in here because you're going into like banker speak, way up the river of abstraction. We need to bring it down for the people.
Right.
So you're saying Basel,
Yeah.
which is basically a discussion of what banks should hold in their books in
Yeah.
reserves. They like to think that they can hold collateralized debt obligations, which are derivatives on their books as collateral, and others flora and fauna of the derivatives world. But there is a discussion that they actually have to have something of solid value, or as you say, terminal value, which is another interesting term, but which would be gold. So they have talked recently about allowing them to hold gold on their books as collateral for these banks, correct? Through Basel, the new Basel III Accord.
Yes.
But to get to your point about the institutional fraud that's going on here on a big level, when you talk about the Basel III Accord, you talk about the banking system, you talk about the central bank system, you talk about LIBOR rigging, you talk about gold price rigging, it does create this global racket, doesn't it, where they're all implicated, including the Basel folks who are fudging on what the definition of collateral is. That's what the Basel III fraud is about. What is collateral? Is it this, uncollateralized piece of paper, or is it gold? What is LIBOR rigging about? What is Forex rigging about? So do you see at this point, you're saying that there's going to be a benefit essentially trickling down to the average Joe, who is now, I guess, the benefit being that they have to, at this point, recognize gold as giving it greater place in the pantheon of the investment world.
Well, I think what I'm trying to say is that the harmonization of law at an EU level has driven some things which are frankly unpalatable relating to the bullion banking system. One of which is the fact that gold cannot be tier 1 at the moment, partly because of the fix. So effectively
Tier 1 referring to the collateral value.
So it can't be considered to be the highest quality form of collateral because the fix is so opaque and it's such a poor system. I mean, even people from Scotia.
So if they upgrade the fix, it can then be considered.
It could potentially be considered.
Which gives it a closer path toward being monetized fully.
Absolutely right. And that's one layer of it. And then the other are these IOSCO principles about benchmark creation. And saying, well, if you're going to have a benchmark in a financial market, it needs to conform to these principles. And as I say at the moment, the fix fails on 15 of 19 IOSCO principles. And so I believe that the fix is coming under scrutiny for that reason, more than it is because of the fact that it's a manipulated market. But of course, the two things are intrinsically related. And you're going to find that because some light is being thrown on this market overall, the other layers of it become more visible and people become more interested in the other components of it. In other words, that's what's driving the investigations. It's the fact that they recognise that this arcane historic process, which is really the London fix is just the tiny visible tip of an iceberg.
Okay, so you're basically you manage funds. You're a money manager, and you focus on precious metals. So when you call clients, institutional clients, retail clients, corporate clients, this is this very solid piece of intel why they should A, be confident of their gold position, and B, presumably to start moving more aggressively into gold, because if it's marching toward monetization, is what you're saying essentially, then the likes of Ben Bernanke, who called it a mere traditional trinket over time, had paid it no respect whatsoever. If it's going to take center place in the global economy, then that price that's currently trading at would seem woefully cheap.
Yes, absolutely. But I think the biggest problem is this OTC market, which makes up 80-90% of average daily turnover in the gold market, the invisible, opaque, dark pool bullion banking market, is being forced to, certainly to a degree, to show how it comes up with price discovery, something we've discussed many times before, thanks to the legislation being wrapped over it. So it's a bit like banks satisfying the arbitrage opportunity to the east in gold while running a fractional reserve system in the west. It's not in their benefit to deliver to the east but they can't resist it. And I feel it's rather similar to do with legislation, which is actually this legislation is going to cause a problem, but it's an unstoppable process. Once it starts, it rumbles along, and one of the benefits has been that the fix is coming under scrutiny as a result.
All right. According to the analysis by this NYU professor who's come out recently, the daily 3 p.m. rigging started in 2004. She found no evidence of it happening before 2004. That seems suspicious to me for all the reasons we've discussed about in the past, but what are your thinking on this?
Well, I think that the obvious coincidence there would be to do with the creation of the ETF market. So that would chime perfectly,
talk about that.
Perfectly in time.
Okay, the ETF,
timing-wise.
exchange-traded funds, like GLD in
Yeah.
New York, where you can buy gold on the exchange, but it's not really physical gold, it's a paper claim on gold.
So by 2003, we were already in a negative real interest rate environment. So the rationale for owning gold became more and more obvious. We were also in a commodities bull market, which is a sort of side pocket comment. And then the financial system, the banking system, managed to collect a lot of investment demand that might have otherwise gone into physical to be delivered and removed from inventories or into the mining shares and collect them in these ETF products. And that happened around that 03-04 timeframe. So it's an interesting coincidence that the main players in the OTC market are also the custodians of the ETFs, and those started around that timeframe when...
Who were the custodians? HSBC?
And JP Morgan are the
JP
two
Morgan.
major custodians of ETFs.
Right, and they were implicated in that other scandal involving silver, but you're saying, as you point out, so much. I want to talk about two other quick things before we go. We have about a minute left. So Bank of England has suspended a member of staff for Forex manipulation. The Bank of England is also implicated in LIBOR. What chance that they were involved or knew of the gold fix manipulation? Quick answer.
Well, it has to have something to do with that because the central banks have been loaning, leasing and swapping their own reserves and those of other nations into the market via the commercial banking system for decades. So.
Okay, next question, last question. Of course, because of all this fraud, the Bank of England has kept interest rates at 0.5% for 5 years. Meanwhile, someone is saying that the average flat in London is going to be worth £36 million. So can they continue, we have 30 seconds left, can they continue defrauding the economy with these 0.5% interest rates for much longer?
I think that that's the only mechanism that's viable for the current banking system. But if the average house goes to 36 million, then I would expect gold and silver to perform substantially better on a percentage basis than the housing market. So if that does happen, then I still feel that precious metals will outperform in that environment.
But we got to go. Thanks for being on the Keiser again, Ned.
My pleasure, Max.
All right, and that's going to do it for this edition for the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Ned Naylor-Leyland of Kilter TV Asset Management. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.